Hello everybody, welcome to the channel. It's Greg here from Ragosa. Thank you for joining us today, and I hope to earn your like and subscription. This video is going to be a recap of the first week, or perhaps the only week, we'll find out, of the Reverse Gamma Scalping and the R&D strategy session. Or series, sorry. Basically, for those of you that might be coming to this video, or coming to the series backwards, and you're seeing this recap first, just a quick rundown. We are looking to sell about 15 minutes after cash open. We're looking to sell a 0-day S&P 500 E mini contract. For about 10 points. So that is the ES contract. So we're looking to sell that, capture about 5 points or something like that in the day of volatility collapse and theta decay, because theta decays very rapidly in these contracts. Volatility also collapses very quickly in these contracts. Charm hits them very, very, very hard, mostly because theta is so aggressive. And these things are very, very sensitive to gamma. And so what we did initially was we looked at the top 9 tickers. We condensed it down to 8. We used Googl, Googl, to represent both Google tickers. So that we started off looking at the top 9, or let's call it top 8, and then realized that just human capacity was such that 6 was probably a little bit better, and then also the physical constraints of our platform, the hardware we're using, like screen size and everything else like this. And not to mention, this also kind of plays into physical limitations. Like if you can only visually see a certain amount of information, it doesn't make sense to pack on more information or have more tickers than you can visually keep track of easily. So we were working on how to narrow things down in the smartest way possible, and decided to kind of land on 6. It seemed half decent, kind of smart. So that was a big structural change for us. What else? Today on the Friday of it, we realized on Thursday the chop that we experienced forced us to try to be thinking about how we could minimize chopping. We were working off of 5-minute charts for the whole week up to including Thursday, and the Thursday session really showed us that on the 5-minute chart it is very hard to really discern how the chop is going, or it is very easy to get caught in the chop with this style of trading, with this strategy here, with this dynamic gamma scalping of the underlyings. And so it's like, okay, let's figure out what kind of time frame makes more sense for us, because we're not trading off the charts. We're using the charts as kind of like a intraday macro direction for the movement, but we're not thinking because we've got some doji or candle breakdown that this is going to tell us where to go. This is not that kind of trading. Basically, we're just looking like for the last 20-30 minutes, are we in a range? Are we in a direction? Are we chopping? What's what's going on here, what's happening. So we decided to go for a 30-second chart. Kind of realized, maybe that's pushing us too much into the realm of the algos, and pulled back for the 1-minute chart later on in the Friday session. And that seemed to be a little bit more comfortable. And then for another way to eliminate the chop, we looked to add in an intraday volume weighted average price, a VWAP. So we were looking to try to put in a 30-minute VWAP, and unfortunately our platform just did not want to update that all the time. You can see right now on Meta that the 30-minute VWAP is working perfectly, and that situation right there with Meta is what we were hoping the VWAP was going to show. The main strategy here for the gamma scalping was to deploy 3 tranches. We would have an exploratory tranche of it started at 10 shares and later moved to 20. And that was just kind of getting a footing in the market. You have to plant your flag somewhere. And so, that's where we planted the flag, and that's where we would churn. We would reverse a position, as needed. But let's say on the case of Meta, you see it coming down to to what the 30-minute average is. And it'd be like, okay, do we want to go long or short right now? We're not playing mean reversion VWAP strategy or anything. It is just to try to indicate breakouts to us or breakdowns in the trend. And the VWAP is half decent for that. And so that's why we implemented that technical indicator. The volume bar that showed up on the bottom is just there because we needed some sort of volume velocity information. Personally, I don't like using it. I'd rather just have the time in sales or the tape. Here I'll show what that looks like for any new people. This right here on the top screen, bottom left, is the tape, the actual orders that have been filled, and the exchange is showing this is what's happening on ES right now. You get to see the size, you see the price that was executed at, the current volume, the time that trade was going through. So you can get a feel for the velocity of the tape by just really how fast this thing is spitting out. And that's what we were hoping to try to capture with the volume. I don't think it did any of that, honestly, in today's session. I don't even know if I really looked at it once. And then we tried to break down a little bit more of market microstructure by adding in the bid and ask spread so we could see if they were widening it out or not. Although what I noticed during the day was it was easy to just not pay so much attention to that. I mean, you pick it up from time to time, but you just assume that it's relatively tight. We added in we added in the first iteration of a gamma indicator. It's a ratio chart of that specific underlie to ES. So it's the idea is to either be a confirmation or perhaps a leading indicator of what is happening with order flow from the market makers balancing their inventory. Did it work? Sometimes it did, sometimes it didn't. Sometimes it was leading, sometimes it was lagging. This being really the first day of implementation, there's definitely more refinement that can be done. This calculation is happening can't remember if it's happening on my machine or if it's happening on the IBKR servers, but that extra calculation induces time delay. So we have the 5-second chart for that gamma indicator, and sometimes the actual price action on the 1-minute chart or the 30-second chart, as the case may be, but sometimes that price action was printing a lot faster than the movement on the 30-second chart, or the 5-second chart, sorry. And that is a calculation delay. It's 100% a calculation delay. You could see that ES wasn't holding or wasn't printing at that moment, and some block was moving through NVIDIA, let's say, and the price of NVIDIA would jump up to capture that current order, and the gamma indicator would lag slightly, like just so slight, but you could notice it. You could notice that delay, and so that's something to look out for. Key takeaways, really, and we'll show this in the blotter here, so you don't have to look over the past 11 hours of trading content. When you're running this kind of strategy, friction makes a big difference. The commissions we paid to Interactive Brokers, now this is a paper trading account here, it's the test account. The commissions, and this paper account is set up the same way as my real money account, the real dollar account. Being an options trader, I want better pricing on options, and I'm usually not trading the underlie. If I was primarily trading the underlie and just in relative speak, only very rarely trading the actual option itself, then I'd want to have the account geared to stock trading. You will see how big of a difference this makes, although I'm not going to go and dig down to see what our estimated commission cost would have been under different account setups. But anyhow, just to give you an idea, that's what's all going on. Let's pull up some metrics here. Oh, come on. There we go. So, over the course of the 5 days, 1,656, give or take, like 2 or 3 if I miscounted on the sheet. So 1,656 equity, like stock trades, were engaged in, and the gross trading revenue on that was negative $391.08. We're gonna pull it up on a calculator here. Now the big kicker is commission costs. Commissions on this was $1,775. That is huge. Okay, that's just huge. But what I want to point out though is, even though we lost money trading stocks, losing money sucks, right? Was it really a big issue? Well, not really, because on each trade we're just losing on average of 24 cents. Oftentimes the bid-ask spread, can widen out on these things. You can watch it dynamically here. Let's look at this. Let's look at the. I don't want to see more details on you. I want to see your bid-ask spread. Maybe I have to click more details. Oh. Now you froze. Well, you know what? This is actually pretty good. It froze the bid-asks. So, oh, no, it didn't freeze. But they're ranging. Sometimes they're 3 cents. Sometimes they're 10 cents. Microsoft right there was printing a 10-cent spread. Amazon right there was printing a 9-cent spread. We're looking on Meta right there's 44 to 64. 20-cent spread on Meta. Now they pulled down to 30 cents. I can tell you right now, the dynamic spread movement is because the market makers are trying to balance inventory right now, and probably a large order is working its way through. And this is kind of why we wanted to build up the gamma indicator to give us an idea of what is going on, so we're not crossing spreads like this, and we can kind of wait out that little intermittent, I don't know what you want to call it, this intermittent volatility spike. Let's call it that, right? I mean, I don't know if that's the right term for it, but this intermittent spike here in spreads, widening of spreads. Kind of want to sit off on that because the spread will come back in. Right now it's back down to 10 cents. But these spreads are dynamic, and that dynamic spread thing is something that we need to try to keep an eye on. But basically, losing 24 cents on average for stock trades means we're just crossing the spread continually, and paying a little bit more sometimes. It's not so great. There's a lot of refinements that can be happening, but keep in mind that this 1,656 trades started from day one, and went through 5 whole days where every day we made some adjustment to the strategy. So this is not reflective of the current version of how we're trading this strategy. This is just what happened. So 24 cents, that's not bad. That's not bad. We can, for 24 cent loss per trade, that's not bad. We can improve it, and that's 24 cents assuming that there is no brokerage commissions, or let's say we've got a good account, or even for any of you quants out there, or quantitative finance students that are looking to get a job at a market maker or a major volatility proprietor trading desk, prop shop. They'll probably have a seat on the exchange or something, a good relationship with a prime broker. You may be paying a penny for these trades, if that, or a fraction of a penny. So if you're losing 23.6 cents, you might end up losing 25 cents on the trade, and it's like, do you really care at that point? You don't care about the brokerage commissions because there basically are none. You care about your actual alpha capture, and so I was trying to figure out how can we really capture alpha, and was there any to be gained? And now we're doing this all manually, and there were some fat fingering. There was some trading execution errors. I didn't keep track of how many execution errors there were, but let's say there is at least 4 a day. There was one fat finger where instead of selling 10 shares, I sold 100, and then I had to buy back 80 of them, I think, or 90, something like that. It was significant. And even on a big blunder like that, a 10x blunder on position sizing or order sizing, sorry, we still didn't get hurt so much. So our tracking was not terrible. Although this strategy is not meant to track the underlying. This is meant to offset the gamma that the 0-day call is experiencing. And it's also meant to lean directionally to capture, movement in the underlie. So ideally right now, with Nvidia looking like it's going down, Google looks like it could be turning down, Amazon looks like it could be turning down, Apple looks like it could be turning down. We would want to be short all of these, and layer in our, exploratory 20, our confirmation 20, and then our continuation, our full size 20. So we have our full position sizing being at 60, and then the discretionary side of, do we want to bump this up to 80? You know, is this a very strong trend right now? Do we even want to bump it up from 80 to 100? This is the kind of stuff that we were thinking of here, and how to trade. So it's really scaling in and out, and I think that scaling strategy is also what kept our gross stock trading loss to be rather minimal. It would be nice to have the kind of breakdown to see how many of these 1,656 trades were just position reversals, especially reversals on the initial lot rather than, you know, not necessarily a panic reversal of like a 40 or a 60 share position, like a full size position, but you know, just kind of like a dynamic, you know, we need to pivot sort of thing. So it'd be interesting to see what kind of breakdown that is. That's a lot more data crunching than I care to do. So we're not doing it. If we're gonna bring this live, that is exactly the kind of data crunching I would do after settling on kind of the bounds of what our overall trading strategy is going to be, and then run it for a week, and let's see how we sit there. And I'd be wanting to run this strategy in the paper account for, you know, like 20 trading days. Try to see how that goes. I want 20 trading days of basically our finalized our finalized gamma scalping for the underlie strategy. I'd want to have at least 20 days of that, and I'd want to have a handful of core call options management. So, you know, are we, you know, rolling it out? How many rolls are we taking? And I'd want to have at least 5 or 6 instances where we have to roll out 1 day or 2 days or 3 days and hold a position overnight, to see how that is working in the strategy as a whole, because that is kind of a macro fix for buffering the gamma that short call, that 0-day short call had experienced. And then also I'd want to see exactly how our risk management is working, and dial in the risk management on the options side of things. So we didn't get to a point of really being able to work on risk management on the call. It was just kind of more general idea of we probably need like a, you know, tail risk out at 30 days. Oh wait, you know, 30 days is not sensitive enough. Let's bring that down to 14 days. But then, you know, watching how the 14-day was moving, probably the 14-day wasn't even sensitive enough for the 0-day. So maybe we need to move tail risk down to the 7-day. But you know, that's something that can be fixed a lot easier in my mind than developing a systematic gamma scalping of the underlie, you know, strategy. So yeah, that's how that looked there on the stock trading. I figured there would be a good idea to put some hedges on the underlies in case there was a big market blowout, and we were caught in a position. Realistically, we would be, since we're managing this thing, you know, so dynamically intraday, the relevancy of those hedges, I think, is suspect. Now, funny enough, We were doing this strategy over an earnings cycle. This was a coincidence. It was not planned to be over an earnings cycle. It is just what happened. And it just so happened to be over the earnings cycle where Nvidia, Amazon, Microsoft, and Meta, I think, and maybe even Google, I can't remember. Anyhow, they blew earnings out of the water. Like completely blew it out of the water. Like right now today, Amazon is up 15%. Microsoft was up like 15% yesterday. Apple got killed. They're down 9% right now. Google's up 6%. But our hedges made money. The first hedges I put on were in the monthly cycle, monthly long 10 delta strangles. And then I decided to go for an asymmetric strangle because I wanted more call side sensitivity, and those paid off. When I closed them out today, just for reference here, the revenue on these things, it was $5,421. So that was a lot. Net revenue then on our equity hedges was 1,567. I would not consider that to be even a thing because we didn't plan for it. On the first day, we tried to zero out some deltas very aggressively using the underlying future product. And we weren't using the ES futures, we were using the MES futures, the micro E-minis, which are 1/10 the size, so we could get 10 deltas per contract and a little bit more granularity. What happened was we lost $213.75 on that delta hedging. Commissions was $15, but we lost $213. So you take that $213 loss, and that was just one day loss, and you look back and you compare it to the $391 for a whole week worth of, not a whole week of trying to discover what our underlying gamma scalping was going to be. And you can see that, going with the actual futures there, it's like hitting the thing with a sledgehammer. We probably don't want to do it. Probably do not want to do it. Using the underlying future might be okay if we were, let's say, selling the monthly cycle. But for the daily cycle, I think it's too aggressive. And because each one is 10 deltas. Now here, when we did our beta weighted calculation, if any of you recall, here are the beta weights. I literally just pulled them from a Gemini prompt because I was too lazy to do the regression analysis myself. So this is 5-year monthly beta. You could refine it a whole lot better. Also, these current pricings are not also accurate. Pricing's changed, but we just used the pricing that we had on I think this could have been like Saturday afternoon or something is when I made this spreadsheet. So there you go. The 10 share delta that we were moving out on Nvidia. Nvidia was like 1.1 delta. Apple was about 1 delta. Google was about 1 delta. Microsoft was about 1 delta. Amazon also about 1 delta. At the time when we were trading Broadcom, that was about 1 delta. Meta, 2 deltas. Tesla, about 1.5 deltas. We pulled Tesla and Broadcom off the trading block. And then what we wanted to do basically was our max position size when everything was loaded in, and if the whole market was moving in a direction, if all the correlations went to 1, and we full sized on each ticker, our effective beta weighted deltas that we had zeroed out would be 256. So let's say 44.3 deltas. And seeing how we were usually selling the 30 delta call, and if we got to a point where we needed to have full sizing on all of the tickers, that call could very potentially be almost at the money or at the money. So having a 44 beta weighted delta at that point seems really nice. We were using even more granularity in our delta hedging if we had to, and then we were trying to opportunistically grab directional trend, and in day 3 we actually very successfully did get directional trend. Day 3 was about 26.5 minutes of trading. Now we could have opened up another position, but I felt that was enough for the day. 57 stock trades and $193 in gross revenue. Now, of course, we gave up $62 of that to the brokerage, but that's an account issue. So $93 because we accurately caught the direction. And then we picked up $322.50 just off the call. Now, if you look down here, the total there is negative because we had a position that carried over the other day. That's neither here nor there. The position opened that day, and the trading for that day was essentially 9 points in ES equivalent in about 26.5 minutes. So we pulled 9 points out of an 11-point contract with sell to open at 11 points is what it was, and we got effectively 9 points out of it when we bought that contract back for about 4.5. That's what this strategy can do when it's working nicely, and that was not even what I would consider to be an optimized version or the current version of the gamma scalping. Why did that underlying gamma scalping work? Most likely, I think, is because when we were using the 5-minute candles, like, again, I was not looking at candle structure or anything like this, but I think the dampening of the price action that the 5-minute chart brings, didn't have us get caught up in algorithmic, or fighting the market making algos as much. So I think that's a key thing to keep in mind. We don't want to fight the algos. We want to just sort of ride the wave, see what's happening. Maybe we have to cut and run somewhere. But if we take a few paper cuts to catch something good, that's what we're trying to do. And we don't want to sit all day taking paper cuts, right? And so that's kind of the balance that we're looking at. What else? I think that's a good recap. Now, of course, we want to see what this could look like when single stock futures come out, and perhaps the single stock futures will be a little bit better. Make things a little faster, a little cleaner, less friction. Definitely some friction that we experienced was the tick rule for shorts, uptick rule for shorts. And there is no uptick rule in futures. If you want to take a short position, you get that short position. So that could be a source of micro friction that we are experiencing. And with us being on such a compressed time frame, that kind of stuff makes a difference. If we were looking at, kind of longer term trends, like who cares about a small uptick? But when we're basically living and dying by the tick, it makes a difference. It really does make a difference. What else? Let's go back to the blotter here. So, some criticisms perhaps. 1600, like 1,600 something trades. How many was it? 1,656 trades. On the surface, that seems like a lot. Was it a lot? It's hard to know. What were the quality of those trades? That's what we want to know. And I would put the quality of those trades, just kind of what it felt like, thinking about the week. I put the quality maybe around 60%, maybe 65%. I don't feel it was strong enough to be 70% quality. But I feel like we could push the quality to 75%, maybe even 80. And that is where it sits. One issue, we definitely had was delayed execution because of my order entry methods. By the first few days were literally just clicking the buttons, and then discovered, we can just put these into hotkeys, preset orders and hotkeys, and run with that. So the hotkeys made it a whole lot faster, a whole lot better. And then I found out today here that the computer started to slow down and started to lag up. It started to lag up so much that it was basically going as slow as when I was clicking the buttons. Now, did that really cause much of a difference? I don't know, and I'm not going to look back in the data and find out, but that's an interesting thing to keep in mind, that things slowed down like that. Also, on the order types, we were not aggressively sweeping the book. And on today's orders, we set them as a limit defined as the mid price at order creation or order entry or whatever, plus or minus, depending on bid or ask, depending on if it's buy or sell, of 1/10 of 1%, so 0.1%. And that just aggressively sweeps the book. And if you're a retail trader and you think that market makers are hunting your stops, or somebody is doing that, or you get hit by liquidity sweeps, that is not what's happening, bro. It is just vol shops or market makers covering inventory, guys like me doing exactly what you can just look back in the last 11 hours of content for this last week doing this. We are just slamming the book to get done what we need to get done. And if you're in the way, thank you for the liquidity, I guess. Thank you. We didn't know you were there, and it doesn't make a difference. But thank you. You did a public service. So anyhow, switching up the order type to just be smart routed orders, and letting the exchange side match us with best book, I think was a lot better than trying to have the interactive brokers adaptive orders, or I can't remember the other one, AccuPricing or something. There's an adaptive one that just kind of tries to haggle around the mid price and stuff, and then there's another one that's like time sensitive. And that time sensitive one was going a little bit too slow for me. And the adaptive one, when the market was moving quickly, it got left in the dust. So that's good to know. I had never used those algorithmic order execution tools ever before. Usually I am just manually working the depth of market and adjusting my own order. So that's that. Like I don't even deal with smart routing because I'm using future index options. Everything is on the CME, so there is no smart. It's all just CME. But when you're dealing with equities, there's like 6 different exchanges or something like that these orders can be on. It can be on the NYSE, it can be on ARCA, or these are all NASDAQ, whatever. You don't know which exchange is going to take it. And so, just let smart run it out. Let those things, get front run a little bit by Renaissance. Let them carp you, whatever. By the way, trading like this is pretty much what Renaissance does, but they don't want to tell you that. They just want to say that, they're a bunch of physics PhDs that can outsmart the market. No. They're essentially a vol prop shop. And they're a very good vol prop shop. Don't get me wrong, I'm not throwing shade on them. I am just pulling back the curtain and saying there's only so much stuff that you can do in this market, and this is basically what it is that they're doing. This idea, and I might make a video about this one day, but this idea that you cannot teach finance people mathematics, I think is wrong. When it really comes down to it, financial markets are messy, they're chaotic, and this is just an auction place. You have auctions on top of auctions on top of auctions, all mashed together, all trying to work out something, and everybody has their own strategy, and somehow in this crazy mix it all works out. And I think there's a bit of beauty in that. But I think trying to idealize everything, what am I trying to say here? The markets don't operate like they do in the textbook. And hopefully, I've shown a little bit of that for this last week. Here is something that for the last couple years, people are saying is practically impossible for a human to do, and I show that you can do that, with relative success. There's some things that we can improve upon, but as for a core idea, this is not dead in the water yet in my mind. There are some things, there are some optimizations that we can be done, and I think we can get down to to actual potential profitability. Just a little bit more work, but it's for a weekend. I think this is okay, and doing it with retail tools is really like the democratization of finance has come, and this is it. And I think it's wonderful. There's no better time to be a trader than to be a trader in July, almost August now, of 2026. It's every day is Christmas. And with that, I hope you guys are having a wonderful summer. If you're in Canada, enjoy your long weekend. And I hope some of you found some value in this. I hope you may have found this interesting. This might be a style of trading that you've never come across before. You've never seen it in action. Maybe you've just read about it, and now you got to see how this works in real time, and you got to see it being done manually instead of just Python code on a screen. You got to see what that Python code was doing, because the code was myself, and we just tried to do it. And were we successful? Did we actually beat the code? Well, now this would be an interesting question. But I think in order to determine if we're going to beat the code, we need to refine the strategy a bit more. And I'm not going to take our our current iteration into that knife fight. I think we need a few more days in the gym, so to speak, before we step into the octagon. So yeah. Okay. All right. Well, thank you for joining me. Oh wow, we're almost 45 minutes. This was supposed to be a short video in my mind. but it is short compared to the 2 and 3 hour long market videos. So have yourself a wonderful day. Bye bye.